afternoon, depending on which part of the world that you're in, and welcome to this end of year review that we're conducting. As most people on the call know, generally every quarter we look at what's happening in the various Australian residential property markets around the country. We look at what's happening in the finance arena. We look at, I guess, a lot of the factors that interact and thereby create some of the outcomes that we tend to see in that asset class. And 2023 has certainly been a year that's caught a lot of people perhaps by surprise, unawares. If I look back at end of last year, end of 2022, a lot of the predictions that were being given at that point in time by various economists and experts within certain spheres, the outcome has been, I guess, anything but that. It's been totally different. And fortunately, I have to say that I think we've been very spot on in terms of what we thought would happen, and a lot of those impacts were potentially driven by things which were not just quantitative or weren't able to be, I guess, researched in the manner that a lot of quants look at, because, as I've always said, and people will know this, residential property is not just a commodity, so it can be impacted by other factors. It's somewhere where people live, so it's actually a lifestyle need. So without further ado, let's start into it. As every good presentation, we have to have a disclaimer, and I urge everyone to read that. This is general information only, and if anyone needs any specific advice in relation to their own situation, then by all means contact us. Bit of an overview for people who don't know the group. Our businesses consist of various separate and discrete businesses. We have Wise Guru, which is the international consulting business that looks after Australian expats all around the globe and assists them with, I guess, many areas that interact with property and finance, and we provide a concierge service there that can sort of tie all that together. Our other businesses are the real estate business in Australia, which is Aussie Property Guru. The lending business, Aussie Loan Guru, specialises in the professions, in the medical and legal professions in Australia, and with Australian expats, again, all around the world. That is really a special niche of assisting people, and we have some unique attributes that we can pass on to our clients, such as 85% LVR ratios with no mortgage insurance, even though they're earning foreign income, and many other benefits, I suppose. And at the bottom there you'll see Unicorp Partners. That was the original advisory business that I founded some 38 years ago, and that's been helping medicos and professionals and other market segments in finance, particularly in Australia, around the world for many years. So that being said, if we look at our clients, it really doesn't matter whether they're a neurosurgeon or an executive banker or someone working in technology. Typically they are earning higher incomes, they're very time poor, they want to build their wealth in a effective and tax efficient manner, and they want to make better informed decisions. So these days, you've got lots of information available on the internet and other places, but most people don't have the time or the experience or the practical know-how to sift through that in a very meaningful manner. And a lot of people want to add property, want to add real estate to their overall asset portfolios. So when you tie all those things together, we can generally assist with one or all of those issues. Our concierge service, that's 4,950 Singapore dollars. That's where we help people with their property purchases, sourcing, execution, ongoing assistance, and that's something we've been doing for a long time, and many of our clients around the world will recognise that actually represents a really great value point, and we get continual positive feedback around that situation. And if somebody wants to know more about that, please just email us or call us and we'll let you know just how we could potentially assist you. So this has changed a little bit. We look at the most common questions that we asked on a quarterly basis, and whilst there's been a common thread that's been running through that for certainly the best part of this year, we're getting more questions around interest rates. Getting a lot of these questions now because people are starting to get more concerned. We've had this massive increase in terms of the cash rate by the RBA, 425 basis points in the space of a year, or just over. And people are sort of starting to feel the pinch, so they're saying, look, maybe we should fix interest rates now. What do you think? And we'll come back to all of those things. Where should we be buying things? Because we hear different stories about different competing, I suppose, factors that help people in relation to making some informed choices if they're looking to buy an investment property. It's different, of course, if you're looking to buy somewhere to live in, and that's something we've got to, I guess, really, sorry, move that. That's something we've really got to differentiate, and often people say, well, look, I want to live in this suburb or these two suburbs, where do you think I should buy? I mean, you can't help people with that really, because they've got to make their own decision in terms of what is the residence that they want to live in, and they're qualitative choices that people need to make. So we can help with the numbers, but you can't help with that. Another one is, how will current interest rates impact property prices from here? Because as we saw over the last year, a lot of those predictions were obviously totally wrong. So, people, especially people in financial markets, were looking at these increases in interest rates and saying that's going to decimate, the asset price of residential property. And it hasn't, because whilst we had the downturn, which was fairly sharp also, especially in, say, markets like Sydney and Melbourne perhaps, prices have now risen to virtually their high points. So I think that probably the next month, so by year end, we'll be looking at Australian residential real estate prices in aggregate being above their high, which was set a couple of years ago. But that'll vary between markets, and that's why it's so important to make sure that you recognise that. And here's another one, what's going to happen to my rents? Will rents continue to increase? And then another really good question, I'll come to some of the factors that are going to influence that, especially the increase in immigration. I mean, sort of what the government terms as long-term overseas immigrants, so someone staying over 12 months and is running above 550,000 over the last 12-month period that was measured. That doesn't include people that are staying for less than 12 months, and they still need to live somewhere. So all in all, a lot of people that are coming into Australia, and once again, if you look back at our reviews over the last couple of years, it's something that I thought may happen post-pandemic, because being an Australian expat, looking at things from overseas, you could see that a lot of people thought Australia was a very attractive place to move to live in, and once the borders opened, you've had this massive rebound in people doing so. This one here, where's the highest population growth? And I think a lot of people that know us know we follow this pretty closely, because I think it's a pretty important fact when you're looking at where you might want to buy a property. Is, what is the population growth like? What's driving that? How sustainable is it, etc. And I guess the question on everyone's lips is, has the RBA finished raising interest rates? I believe it has, unless there are some skewed upside surprises coming in the new year in relation to inflation and CPI data. But I think that probably my base case is that they finished raising rates, and as we can see in financial markets around the world, They think that the Fed has finished raising rates, and they're now looking at, you know, how many rate cuts will come in 2024 and how big they'll be. So if we look at this, and again, you know, most people recognise this that have been listening to us, but other people should know, because Australia is such a vast continent, and there are so many both developed and major real estate markets in that continent, and then sub-markets, research is really, really important, and you need to look at what to do with that. Now the 2023 outlook is coming to an end, and I think, you know, what we've been saying over the last year has really played out pretty much to what we've thought. It's now a question of looking at what's going to happen then. We'll do this in our next review, going through 2024. All the commentators have now changed their tune totally from this time last year, and what the numbers are showing us, and I look at, you know, the data that's coming through rather than someone's crystal ball, and it looks to me that you know, the outlook remains actually positive for 2024 in terms of price action. So I think prices will continue to increase. However, I think that the rate of increase is slowing and will continue to slow because, you know, the impact of the higher interest rate environment is having a flow-on effect as the Reserve Bank intends it to. However, there are many other factors at play, and I'll come into that during the course of this presentation and hopefully give you some more information about that. We use all of the, you know, sort of national research houses and look at data from the various providers, but I think it's invaluable to have that experience of, you know, 35 years in these markets to actually be able to give our own practical overlay onto these numbers, because the numbers alone don't allow you to potentially make the best decisions going forward, because they don't take into account these qualitative factors that are very important when you're looking at residential real estate. So here, you know, here's the one that everyone's looking at. What's the RBA going to do? Where are interest rates going to go? And if you look at that chart, I mean, we've had an incredibly steep and quick rise in rates to the current 4.35% official cash rate. I don't think that the board's going to do anything in December, and I'm not convinced that they're going to do anything in the early part of next year, because I think the impact of the current rate increases is still feeding through the market. You're still seeing a runoff of very low fixed rate loans, and then people still have had some savings buffers, which these increased mortgage repayments are now going to eat into. So I think that's going to do a reasonable job for the RBA. And the other thing that I look at now is that I think that the US dollar, which is showing signs of this over the last couple of weeks, is starting to roll over, where the markets are pricing in rate cuts next year rather than increases. So I think the differential between the Australian dollar and the US dollar is going to compress, and thereby that will assist the RBA in relation to inflation, because any goods that are imported to Australia that are priced in US dollars are going to become cheaper for consumers to buy, and most tradable commodities in the world are actually priced in US dollars. So I think that's going to give the RBA a bit of assistance, and we'll have a look at February at their meeting then. But I think we should probably stay on hold. And just to say, to add to that, I think that Australia will cut rates at some point next year as well. And I've been saying for a while it'll probably be around mid-year. A lot of the bank economists think it might be, you know, in the third quarter. But either way, I think that will also continue to happen as we see the unemployment rate tick up, and the Reserve Bank trying to obviously protect employment, because that is also one of their tasks. So, you know, interest rates are continuing to rise for borrowers at the retail level. I think we all know about that. And when I go back to some of those earlier questions about people saying, you know, should we fix now? That's really a fear factor coming in. People are afraid of what might happen. So I think the most look, the most low risk way of treading water with this, or treating this, is to remain on a variable rate now and see what happens over the course of 2024, because as I've just said, my feeling is that during the course of next year rates will come down, and if you then want to buy some peace of mind insurance and look to refix, you're probably going to be able to do so at a more favourable rate than you would now, when I think we're sort of at the peak of its current cycle. This is something I alluded to here, and this is where Australia is different, and a lot of commentators are saying, well look, you know, the RBA's only raised rates 425 basis points, unlike the Fed in the US or New Zealand or the UK raised rates far more. But all these different countries have different transfer mechanisms of how monetary policy works, and if you look at Australia, you know, normally speaking, over 80% of mortgages are on a variable interest rate, so the impact of these rate rises is felt virtually within, you know, 30 days of them happening by the retail borrower. Whereas in America, where, you know, typically a lot of mortgages are on 30-year fixed rates, people there are still paying 3% or less for their interest on their mortgage payments, so they're not moving house and they're not changing loans, because now if you look at the prime rate, it's, you know, 8.5%. So why would you do that unless you had to? You had to move for, you know, employment reasons or whatever. So I think that again, this will enable the RBA to potentially stay on hold and then look at reducing rates in due course, and that's another reason I actually feel a little bit more confident about the Australian economy than perhaps economies in other developed nations, particularly you know, Europe and the UK, and the US also. But you know, you should never underestimate the Americans. So they're the sort of macro levels around this, and that, I think they augur well for us as Australians and Australian expats. And I think we should probably fare better than other nations. So this is Westpac's commentary in terms of where they see things happening. I agree with this. You know, if we look at the cash rate there, you can see they're on hold till the third quarter of next year, and somewhere in that region there, I also anticipate that, you know, the RBA is going to start looking at reducing rates, and as you can see there, over the course of the next couple of years, you're looking at a reduction of, say, over 100 basis points in their view. Of course, these things generally don't play out in a very measured way like this, and as we see on the way up, also on the way down, I think markets can misprice some of this. So if unemployment does start to run away, you know, the Reserve Bank then is going to start looking at protecting jobs, protecting people's jobs in the economy, and they may act in a more aggressive manner in terms of reducing rates to make sure that the unemployment level doesn't rise too quickly and doesn't go too high. And if you look at the US, they're particularly prone to do that. And then of course the other outcome from that, like let's say the Fed starts cutting more aggressively next year, the US dollar's obviously going to potentially suffer from that. So you might see the cross rates with the Aussie dollar spike somewhat. And the caveat to all of that, of course, is that if the Fed has to cut rates too quickly because the economy is tanking, then you might get that flight to safety factor, which would be reverse to that, where people quite often go and look at the US dollar as being the reserve currency of the world, and that will generally be a tailwind for, you know, for the US currency. So a lot of moving parts there, and a lot of things that can act perhaps in various ways, and some of them counterintuitively. So if you look at property, it's important, and I say this because a lot of our clients, obviously being Australian expats or living in Australia, and Sydney's a great example of this. You know, people say, oh, Sydney's just so expensive, and yes, it is. But if you look at other places around the world, you know, they're similarly also very expensive. So if you have a look at what, you know, house prices have been doing, they've been rising in most advanced economies. And you look at the US, Canada, Australia there, So, and this has been in a rising rate environment. But what you've got to look at then is look at what's driving that. And there are several other factors driving that, because supply is being constrained greatly by this, because people who are looking to construct new dwellings are saying, well, we can't do that and make it work because it's too expensive. So we'll go through some of the impacts of this. But this is a global phenomenon. It's not just Australian-centric. One of the key drivers to that, as we've always said, is population growth. And if you look at what's happened there, and these, don't forget, these are lagging indicators, but these are the latest numbers. We've had the highest quarterly net overseas migration recorded again. And I think that's probably going to start peaking soon now. But it is a big number, and as I said, it's over 550,000. But if you add all the other people that are staying less than 12 months, it's probably 800,000. So it's a lot of people. You've got to look at where many of those go, who they are, so what they're going to do. And don't forget that most of the people that come to a country, whether that be Australia or another country, will tend to rent their accommodation, certainly for the first year or two. So let's look at all of those things and then see, how that fits through and how that impacts all these various markets around the country, and perhaps sub-markets within those. So if you look at this, and I think it's a good way to look at things, the blue bar's net overseas migration, the green is natural increase, so births over deaths, and the ochre bar there is net interstate migration. And Australia being such a large continent, this interstate migration is a very important factor and plays an important role in demand drivers, and that's what we look at. It's a combination of these things. So if you look at the various states and territories, you can see that overseas migration has been contributing to virtually everywhere. I'll look at the numbers for you a little bit down the track. Western Australia has certainly over the last 12 months really moved up there. Queensland has been very high and remains so. And then if you look at net overseas migration into places like South Australia, we'll have a look at the actual numbers, and not how many people, a little bit down the track. New South Wales and Victoria tend to have outsized net overseas migration. A lot of that revolves around a younger demographic, so a lot of students coming in, and we'll see the impact of this on, say, sub-markets. So in areas like, in the Sydney markets, the inner south, inner southwest, the inner city areas in Melbourne will tend to have excess, if you like, rental price growth, which I've established over the last 12 months, and that's due to a lot of these overseas students coming back and wanting to live close to where they study. So in hindsight, everything's really, really makes a lot of sense, but you've got to look forward. New lending, that's also a good indicator for us to see demand and how that's playing out. There's a difference between owner-occupiers and investors, and then there's another segment that we call first home buyers, which was really, I guess, squashed a year ago with the rapid increase in interest rates, but it's starting to rebound now a little, and demand for finance from that market segment's increasing again. If you look at things here, new lending for investment running a little above trend, 35.8%, and you've seen this massive decline, then uptick now in owner occupiers and investors. So another metric that we look at, it's starting to actually, because I've been watching this closely for the last few years, and it's starting to become really quite stable, I suppose, when banks look at what they perceive to be riskier lending, interest-only loans, high loan-to-value ratios, high debt-to-income levels, etc. They keep dropping, and if you have a look at some of these statistics here, you can see that on a historical basis, a lot of these riskier type of loans are running way below trend. So, I think the Australian banking system it remains in pretty good stead, even though people have been, saying the opposite for the last 18 months now. I think it remains in very good shape. I think the processes they have in place for people to obtain a loan are very stringent. Just ask anyone who's trying to get a loan. So I think, again, we're in good shape there. Then let's look at property as an asset class. And, if you look at that, it's now, the value of residential real estate in Australia is over $10 trillion. And what a lot of people forget, as I point out, is that the mortgage debt outstanding on that is $2.2 trillion. So, especially in, say, markets like the East Coast capitals in Australia, Sydney, Melbourne, Brisbane, you speak to someone and they say, oh God, how are people buying these places? And here's a bit of an insight. We look at the numbers. A lot of people these days are paying cash for their new property purchases. And we see this in other sort of lifestyle markets, particularly the Gold Coast and Sunshine Coast of Queensland, and North Coast, South Coast in New South Wales, where a lot of people are actually buying these residences that they want to live in, and they're paying cash. Many of these people might be in the sort of reward stage of their lives, so their kids have left home, they're selling up a property, and they may have paid, $50,000 for that property 35 years ago, and they sell it for 3 or 5 million, depending on what market it's in, and they can afford to spend that on perhaps a dwelling that suits their lifestyle needs now. So it might be, an apartment in a complex that gives them security and amenity and all of those things that they're looking for, and they don't need a loan. So all of these things need to be borne in mind when we look at things and see how those effects then work their way through the economy and through the localised economy of different areas. Now, if you look at national home values, they've increased by, 5.6% over the last year. It's probably closer to about 6.5% now. But you can see there the last quarter, 2.3%. And if you look on the right-hand side of your screen there, some of the smaller capital cities are now at record levels, and we'll go through the breakup of that and have a look. But it's certainly not what people anticipated this time last year. So here, if you look at various markets around the country, that's what I'm saying, the smaller capital cities. So Perth, Adelaide, Brisbane are showing the most significant 3 monthly changes. If you have a look here, Perth 4.6, Adelaide 4.2, Brisbane 3.8. They're exhibiting some very strong growth. As I said, overall though, I think that markets around the country will show a far lower rate of growth or rate of price increase over the next 12 months because what's driving a lot of this too is that people do have cash to spend, so that'll remain. However, interest rates do have an impact on the, say 30-odd% of people that use banks to fund their property purchases, and also for the other, say 30% that use banks to fund the investment portion of their property purchase needs. So a couple of different factors there, but I think prices will increase next year, but it'll be at a slower rate. And of course, you've got to look at then, that's not a sort of vanilla statement. You've got to look at where these things are going to happen more significantly than others. And in some places prices do decrease. If you have a look at Hobart here, Darwin, ACT. So important to keep that in mind. But as you can see here in all market segments, so the upper, middle and lower, Brisbane, Adelaide and Perth are showing the really strong growth at the moment. Sydney's been really good too, coming, as I said, came off pretty strongly there, but has rebounded very strongly. Melbourne's probably the market that's sort of lagged, I guess, on those, certainly on the major capital side, the most. So we'll have a look at this, but here's where, you know, supply and demand, as I say, has proven to be, what we always say, a very important factor when it comes to residential real estate. So dwelling approvals fell another 4.6% in September, and they continue to trend, you know, well below historic decade averages since the start of this year, perhaps longer. And that's the impact of these higher interest rates. So, you know, land values and construction costs are rising. Construction costs gone up, you know, 45–50% since the days of the pre-pandemic levels, and that's making it really difficult for developers to bring new supply onto the market. They simply can't make things stack up from a feasibility viewpoint, and that's continuing to suppress new supply, whereas demand, as I said, on the other hand, due to not just rising population growth but also household formation. So since the pandemic, a lot of people, you know, have shown that they want to decrease the average household size. So that's still an ongoing process, and I can't see that going away in the short term. So that leads me to believe that I think rents are going to remain high for longer, until potentially rates do start coming down and people can start building new supply and do that on a profitable basis. Or something goes off the rails and economies start to contract, unemployment goes up, and, you know, we have a knee-jerk reaction from central banks that way. But in reality, that's what's happening. I've been, you know, looking at these markets for decades, and I've never seen the new supply market as challenged as it is at the moment. So if you have a look at this, and you know, we speak to people in the industry, many of them are large listed businesses involved in building smaller ones, and many of those have actually gone broke over the last 18 months. And of the ones that remain, you know, we look at this and we say, look, what's going to happen to the supply? And say, well, we can't go out and build something for $100 million and then say we're going to get 90 million back at the end of the day. They're not going to do that, because you know, the idea of being in business is to provide a profit and provide a return for your shareholders. So if you look at this here, I think this is where the challenge lies. I know a lot of people saying it's based on, you know, government can help this in terms of reducing the bureaucratic process to obtain approvals, releasing new land, etc. But what we have to remember is that a lot of areas that people may want to live in don't possess any new land to be released. And certainly the bureaucracy around various levels of government can be improved greatly to assist, but it's not going to do the trick overall. So it's really, again, getting to the point where, you know, prices get to a certain stage where people can build new supply on a profitable level, which would indicate that prices potentially need to go up further, or interest rates need to become less, or a combination of those two outcomes. So, you know, rental market, people ask those questions, as we pointed out up front. A lot of people asking about their rents. Well, if rates are going to remain higher for longer, there's that rhetoric in the marketplace, everyone seems to pick up on phrases, then that means rents are probably also going to remain higher for longer. Again, we've seen the rate of rental increase peak and decline somewhat in many markets, but not in others, just depending, like I say, some of the inner city suburbs of Sydney and Melbourne, where you've had this massive influx of overseas students, they're still showing, you know, especially say in apartments, they've had rental growth of 18% over the last 12 months. So, you know, it depends where it is and what it is. So if you look at this here, rents increased by 0.7% in October, taking national increase to 8.1. But if you look at that graph, you can see, you know, how we're sort of plateauing, coming off a little bit here. And some of that's also, I guess, driven by the value of the actual asset that's being rented. So again, you know, a bit of an inverse relationship there. On yield, this is just nominal increase in rents. But if you have a look at this here, you know, Perth, has had a really strong increase in rents. As I say, Melbourne there, I mean they've all been strong, but that's a standout. So that's certainly helped people in the West. Then if you have a look at housing values, you know, again, if you look at this, that yield compression is due to both factors, I think. So it's due to perhaps rents starting to slow in actual nominal growth, and also the increase in value of the asset, of the houses or the apartments that are being rented increasing. So you've had this compression in yields. As you can see, it hasn't been large, but if you look at Sydney, you know, and this is coming back to, I suppose, things that I'm more familiar with over the decades. I mean, with Sydney's generally been the lowest yielding rental market around the country, and that's, you know, the whole of Sydney. Again, you look at sub-markets and look at various changes there, but that's starting to look more like it did over you know, over past longer term cycles. So what do we do with all the data apart from looking at it and collecting it and so forth, and what does it tell us? More importantly, you know, how can we use that? How can our clients, our viewers use that? And as we know, and as most people know, even though they ask about the Aussie property market, there really is one. There are just so many, and then the markets within those. So you've got to look at a whole lot of other factors. This is now, I've been showing this chart for actually probably, you know, over a year, as most people who've been on those calls will know, because it's really important, and it just shows you the validity of this, because housing prices during tightening cycles, now if we go back a year ago, everyone was, you know, predicting that real estate prices would plummet. I had people from around the globe, you know, talking to me about, you know, they'll be buying into the market when it's 30 to 40% less, and so forth and so on. But, you know, again, I look at numbers, look at data, and look at what's happened to housing prices during prior tightening cycles. And as we can see, you know, it's been a very mixed performance, with some decreases and some increases, and this current cycle is showing the same outcome. So it looks to me as though we may be following more on the path of, you know, what sort of happened around '99 during that cycle potentially. We'll find out next year, but keep an eye on that. We certainly will. So looking again at something we spoke about over the last 2 years, where I said, you know, when the pandemic came along, that I thought that actual prices wouldn't be impacted greatly, but I thought that transaction volumes would be impacted greatly, and they were. And if you look at now on a national level, listings are still trending, you know, nearly 19%, so nearly 20% below their 5-year average. If you have a look at this, the dotted line's a 5-year average. So what's happening is that people are choosing not to sell their assets. And some of that may be, you know, you look at things and you look at high interest rates now, and people are saying, well, you know, if I sell my house, what do I do then? I've got to go into the rental market. And that's certainly, you know, nothing to look forward to at the moment, because there's a lot of competition for those homes and apartments, and they're expensive. So I think, you know, this is something that we looked at, and it's playing out, and it seems to be showing me that sort of supply constraint is going to cause people to try and keep their existing assets if they can afford to, and will continue to play its role in the overall market balance. So if you look at new listings, you know, they're trending a lot higher over the last 3 months, especially in Sydney, Melbourne and Canberra, and that's something we looked at the last review, saying that, you know, that hopefully we will start seeing an increase in listings, and it actually started coming through some of the winter months even, which is traditionally a low listing level, if you like, on a seasonal basis. But people were starting to potentially feel the impact of the raised rates, or simply thinking, okay, there is a lot of pent-up demand, buyer demand in the market, let me go and test this with my property. And that's what's been happening. It's been a great benefit for people who are looking to purchase something, especially first home buyers and upsizers in those East Coast capital markets in particular, who have been sort of kept out of the market or been sidelined because they couldn't find a suitable property, and if they did, they were outbid. So I think that's helping, and we're certainly seeing on a granular level amongst our own client base that, you know, more transactions are occurring. It's certainly no runaway steam train, but, you know, things are improving there for people who are buyers, and hopefully they'll continue in the February-March selling season, because on a seasonal basis, obviously now coming into December and January, they're traditionally very quiet months for real estate markets. But, you know, if you look at this again, a big variation between the various markets, and I think good to see from a lot of levels, certainly for people who are looking to buy something. So if you look at house prices after the last interest rate rise, and that's now becoming a far more relevant, I think, data point or you know, topic to discuss than it was, say, in the last 3 or 4 quarters where we've shown this slide, because financial markets now think that the Fed's on hold and looking at rate cuts. I think the RBA is probably on hold, and you can look at rate cuts at some point during next year. So if you look at what's happened in prior cycles, it's probably more relevant to look at what's happened over, you know, 2 years, 5 years rather than 1 year. But as one could expect, if we saw central banks starting to decrease their official cash rate next year, I think that will give some kind of impetus to the property markets around the place, because it makes sense. So where people have been trying to enter the market but have struggled due to the cost of mortgage repayments due to interest rates, the second factor, I think, and this is a really important one, is bank serviceability ratios. As that improves for potential buyers, I think that's actually going to have a pretty big impact in relation to both transaction volumes and potential price pressures as we go forward through next year. Even though, as I said, I think in many markets the increases are going to be far less aggressive than they have been during 2023. So if we come back and we show all our viewers and our clients this, you know, it's as easy as pie, and that is, if you're looking to buy a property, particularly as an investment, you know, you've got to look for population growth, infrastructure growth, and employment growth, and quite often, you know, those three things can meld together pretty well from a macro level. So if we look at Sydney, New South Wales remains the strongest and most diversified economy in Australia. It's still, you know, if we look at rates, and if we look at rates remaining higher for longer, or potentially having another uptick next year, even though that's not something I anticipate, there's still the highest downside risk, I suppose, there due to affordability. But what we're seeing really is, you know, you're seeing this ongoing demand for quality assets there, that's been there for a long time, but now, you know, it's being driven, as I say, we find a lot of people from different parts of the world, Aussie expats around the world, who've been looking to get into that market because they're potentially thinking of moving back there in due course, or for other reasons. Still continuing to put, I think, upward pressure on that. The quarterly house prices, you'll see, have slowed, and immigration remains strongest in the country. So, you know, all important factors, some acting against one another and some providing tailwinds to one another. So if you look at, you know, the quarterly increase in Sydney was 2.5%, but over the last year, values have gone up 9%, and they're now 2.2% below the record. That's probably going to be eroded over, you know, these 2 months to the year end, to it being pretty close to where it set a record prior. So, Sydney's been going well. Victoria's been a lot more muted, or Melbourne, I should say, has been a lot more muted. There's been great immigration, overseas immigration there. Again, a lot of tourists, which Melbourne has always done well in terms of promoting its learning institutions. Rental affordability, strangely enough, remains pretty good in Melbourne. It was the cheapest capital for quite a while this year, and it's not far above that, and it's still providing good value for people to rent. Quarterly price growth has been muted, and I'll show you that in a second. 1.2% for the quarter. Values have only gone up 2.4% over the last year, so they're still 3.7% below their peak. So a more muted response coming from Melbourne than, say, Sydney or some of the other capitals. Perth has been a bit of a standout. Strongest annual capital city price growth. It's got high population growth, particularly from overseas, but also from interstate. Highest level of annual rental growth, and it's still affordable because don't forget, Perth came from a very low base when you compared it to certainly the East Coast capitals. So if you look at that, Perth has increased by 4.6% over the quarter, 10.8% over the year. And values there currently at a record high. Same goes for some of the other smaller capitals, Adelaide. So this is a question that we get quite often. What do we do? Should we buy something that's old? Should we buy something that's new? And it really depends, I suppose, a lot on what you're looking to do. Is it a home that you're looking to move into? And you want to change things to make them fit exactly what you want? Is it an investment that you're trying to renovate and gain some outsized gains from? Are you one of our typical clients where you are really time poor, you're earning a high income, you're generally paying a high level of tax, and you're not, haven't been in the construction industry, you might be a lawyer or a doctor or a banker, and the answers will be different for those people. So for our typical client demographic, it's generally new properties because they're easy to maintain, easier to rent. They give them tax advantages that old properties don't, and these people don't have the experience or expertise or time to try and renovate somewhere and add value on an efficient basis. And in the current market, when builders can't get things built, it's also a bit of a I guess a bit of a hard task to try and go and do that yourself when you can't actually manage some of those costs that you might incur along the way. No right answer, but it just depends on what you're trying to achieve. A lot of our clients, especially the expats living away from Australia, really want something that's as easy as possible to rent and manage. And I find most of our clients in Australia are actually in the same boat. So if we look at some of the benefits that come uniquely, I suppose, in the Australian tax system, Division 43, Division 40, depreciation allowances are really important. And I'll come back to a question that someone asked me, which we can cover off at the end in terms of how this plays out if you're a non-tax resident of Australia. But that's a big one. I mean, construction costs being what they are, so if you get a new dwelling, the tax office allows you to claim a deduction for 2.5% of the building cost over 40 years. And that can be a pretty significant saving for most people if you offset that against your personal exertion or other Australian taxable income. So if you're working in Australia against your salary or other personal income, and if you're an Australian expat, against your rental income or other income that you may have in Australia that's considered ATI, Australian taxable income. So, what does all the data tell us? Well, it tells us that it's a region that we've liked for a while. Still deserves, I think, keen investor focus at this point in time, and that's southeast Queensland. So a lot of our viewers, a lot of our clients will have seen some pleasing outcomes from there. It's still showing a very substantial valuation gap when compared to Sydney. It's still showing the strongest interstate migration over the last 15-20 years. And in fact, it's been increasing on a quarterly basis as we've watched it over the last 6 or so quarters, 8. The work from home or the lifestyle factors still seem to be playing out a pretty important role. So we see that particularly in those coastal markets, the Gold Coast and Sunshine Coast. And that's again, one of those demand drivers that's increasing even the shortage of supply there. And their economy remains well diversified, and I think on a cost of living basis again represents very good value when you compare it to, say, some of its southern neighbours. So if you look at the price changes there over October, 3.8% for the quarter, so that's been pretty strong. Perth was 4.6%, 7.8% over the last year, and like Perth and Adelaide, dwelling values are at a record high currently. So, but we've got to look at some sub-markets there, some dwelling types where the rate of price appreciation has changed. And now if you have a look at, and I said this at the beginning, if you have a look at the actual numbers of people that are moving between states or coming into those states from overseas, if you look at something as a percentage, that's one thing. But if you have a look here, South Australia, for that 12-month period, had net interstate migration of 157 people. So this is just something that, that we look at and we've got to then put into some context, because whether it's 1.2% or 150 people might make a difference in terms of how much actual supply that influx would require to be housed in. So if you look at New South Wales, by far and away the largest outflow of people from New South Wales, and that's mainly from Sydney, by the way. Melbourne, the next largest, but far different. If you look at, on the plus side, if you look at Queensland, by far and away the greatest number of people moving between states. So you can see that Western Australia, the second largest there, but the other states, no. So then if you look at overseas arrivals though, there's a big difference, because again, look at the numbers. Net overseas arrival in Sydney, 153,000, 137,000 in Melbourne, 70,000 in Brisbane or in Queensland, and then as you can see, 52 in WA, and very small numbers for most of the other states. So these are really important things, and if we look at that rate, I suppose, of both net overseas migration and interstate migration, put them together, it'll give you a pretty good picture of what particular areas need to house those people, and then you can look at what demographics make up that cohort of people that are moving in there. So if you look at this here, this is Queensland. A lot of that's basically southeast Queensland. Natural increase, net interstate migration, net overseas migration. And you can see the big bars here for basically Sydney and Melbourne on the overseas migration side, and different attributes, because a lot of these people are overseas students and they'll be looking mainly for rental accommodation rather than looking to purchase something from a percentage viewpoint. So the other factor that we've looked at is what's happening with the Olympics. And I mean, whilst this was something that's over 10 years away, etc., but it's now less than 8.5, or about 8.5, and that'll keep winding down, because what it actually has promoted is a large spate of infrastructure development for Brisbane, Gold Coast, something on the Sunshine Coast. So that's southeast Queensland triangle. Many of these projects take years to complete, but they also require a lot of workers to build them, and then obviously will increase especially traffic infrastructure efficiencies and other efficiencies, and continue to provide both employment and ongoing avenues for population growth. So it's something that's a long-term driver, and as you can see there, you know, the economic benefit to Queensland is $7.5 billion. KPMG predicts that for Australia could be worth $17.5 billion. But if I look at what happened in Sydney, 2000 Olympics, and you look at sort of that 7-year period between 93 and 2000, Sydney dwelling values were up 60%, which was almost twice the growth across the broader market. And these are historical factors, but it's something to look at, and if you can then overlay them with, I think, as I said, these current situations where you look at the macro things of, you know, the population growth and the infrastructure growth and the employment growth, and look at the cost differentials, put all that together, and it should give you a reasonable thing to think about. So if we look at now, just play this for everyone to have a little look.
What 2032 will do to enliven our city.
The latest look at what could be Brisbane's Olympic Park in 2032. A floating pool in the Brisbane River, Southbank's Arbour Walk extending from the Gabba through to the city, urban rainforests lining the water, with public transport and green bridges connecting venues like Suncorp Stadium to Brisbane Arena at Roma Street, the Brisbane Convention and Exhibition Centre through to the Gabba.
So if we have a look at that, you can see there is really a lot of infrastructure that's being, what's currently being built in Brisbane in particular, and revolves around a lot of different, I suppose, aspects. So traffic infrastructure, pretty important, not just roads, rail and rail, but the under river rail. It's end up being probably close to a $5 billion project. That is starting to link up the city north to south and all the way through down to the Gold Coast. There's a road infrastructure being put up towards the north coast. Brisbane Airport completed its parallel runway a year ago, so the actual throughput there is now capable of doing the same numbers as Changi in Singapore or Hong Kong airports. So a lot of things happening, and there's also a lot in the hospitality F&B sector, and it's something that I see when I go to Brisbane these days, just the number of high quality restaurants, eateries, other F&B possibilities there are just exploding, where it's, I often say to people, it's coming like Melbourne except with better weather. But really I think they're really focused there in terms of doing a pretty good job, not just in terms of the Olympics, but really creating a massive amount of amenity to continue to drive the population's ability to grow there, and to do so, I think, in a really comfortably measured manner. So it's something that I look at, and it's something that's really difficult for, say, a city like Sydney to reproduce, because the local planning laws have just made it so difficult. I mean, trying to do a good job in Sydney in terms of producing some of the light rail and metro and so forth, but it's just almost impossible to try and emulate what's happening here in Brisbane. And Melbourne has some challenges in relation to public spending, etc., that's happening there, which are perhaps hamstringing some of the infrastructure development that's required to continue to improve that city. So, what's the value proposition? Well, I think I've sort of said, as we've been going through, that, yeah, the light does have to come on sometimes, and you need to put a lot of this information together so you can make some well-informed decisions in terms of what you're going to do in light of perhaps your current or future property investment decisions. So if we look at this, it's something we try and help people with, and that's in stopping people making common mistakes that we've been seeing for decades. Try and buy into strong markets of the future, or look at markets that are going to be strong and be sustainable over time, rather than trying to jump into markets at the top of their cycles. And a lot of people tend to do that. That's not just into real estate. I mean, we see that with all sorts of assets. People buying into equities or certain portions of the equities markets, certain subsectors. You've seen it with alternative assets, with crypto, with many other things where people generally rush in near the top of cycles. So important to get the information. There's lots of information available actually, but there's lots of research too. But how do you make sense of that? Because a lot of it can represent numbers in conflicting ways, so you just don't know what to actually do with that. And as the last year has shown many people, the outcomes of a lot of experts utilising that data have not led to the outcomes that they thought they would. So waiting too long is another thing that I think people, often get wrong. So, and I've seen this with clients where they've been looking to buy something for the last 2 years plus, especially say in markets like Sydney, and they keep missing out. Now, and that's potentially to save, $10,000 on a $5 million house, let's say. That would have cost you a lot of money if you'd been doing that and you're still doing it, because now you might be paying an extra few $100,000 for that property that you're looking to save $10,000 on. So, different sub-markets, as I say, move in different ways within all of these Australian property markets, and people need to look at that so they can continue to wait for something to come down to what they think the value should be, or they can accept that the market actually sets the value, and if something sells at auction for a certain price and assets around it sell for those prices, and that's probably going to be the price. And these two are mainly dealing with property investors. You shouldn't ignore your point of difference. I think you should always look for unique attributes for the property, and any investment won't do. So, just because you haven't bought anything and been wanting to for 3 or 4 years, don't sort of just go and buy anything, because I think it's really important to buy the right quality assets, and this is just an example. So, I say beware of single economic themed areas. So if a property market relies just on one economic outcome, like in Port Hedland, I've lived there, it's iron ore. Fortunately, it's gone pretty well, but there's been some massive volatility in a market like that, as you'd expect, so it's something to be aware of. A lot of lower quality, sort of investor grade apartments that are, compromised floor plates, small, odd shapes. There are hundreds of the same things in a particular building. I would say it doesn't matter whether that's in Melbourne or Surfers Paradise. I'd stay away from those things, because I don't think they're really going to help you in any meaningful way in terms of capital appreciation over the long term. Certainly not showing points of difference or unique attributes that I think people should look for. So if we look at that with some more granularity, I'm just looking at Brisbane here, and it's something that, pretty familiar with those markets. The availability of new supply is just going through the floor, basically. There's plenty of demand, and that's being shown by price value growth over the last few years. But there's just no new supply coming to market of any note. As you can see, it's so undersupplied on a 5-year basis, on a 2-year basis, 1-year basis. You look at whatever number you want, it's totally undersupplied. And if you went back to that slide where I showed you the number of people coming into the state, and a lot of them into, obviously, Brisbane being the capital, there's just no way that the new supply can meet that demand or even go close to it. Here's the other thing, because we've been looking for a while at people saying what else has changed. It's not just the number of overseas migrants that are coming into Australia. It's also that people have changed their preference in terms of where and how they want to live, and COVID sort of turbocharged that a lot. It led to the situation where you have smaller household formation, so people want to live on their own, or twos, or couples. They wanted more space around them, and I think that's been going for a while, actually, before COVID, and I think continues to happened now. So I think the only thing to change that will be if rents continue to keep increasing and remain high, that you'll start getting the formation of share houses again, because that's something that obviously unravelled during that pandemic period. But if people can't afford to live like that, then they might start going back to sharing houses and sharing the rental expense. So if you try and put all that together, I think it's, the theme throughout this is look for these unique attributes in the property, look for the macro factors, the population growth, the employment growth, the infrastructure growth, look at the future sustainability of that, and look at strong economic activity that is sustainable and is sustainable for some pretty long-term factors rather than just something that's a blip in the overall time frame. So if we look at, some of the opportunities that exist towards the end of this year, and there's not much of that left, but then into 2024, it's still very difficult, I think, to find these quality assets in the right locations to give you a good outcome. And I mean, I speak to people in the listed space that are involved in property, and some of them have interesting ideas where they think that residential property is really just a commodity, and developers and builders will continue to provide that commodity once prices increase to a sufficient level or interest rates come down to a sufficient level, so they can go and build things and make a profit. Inherently, that's a great concept, and if you're in that business, you may well be looking at that. But that's where I think a lot of people got things wrong over the last couple of years, is that people aren't quite like that. They actually want to live in certain areas where property there isn't a commodity, because you can't just release new land, or you can't just improve a DA application process because it's not available. And that's what we try and help clients look for quality assets that have unique attributes, and I think that's one of them. So just if somebody says that to you, just go and say to them, well, how much more land are you going to release around Sydney Harbour, and see how you go with that. So people have got to look at, I think, some of the realistic attributes as well. This is the Gold Coast again. If you look at unique attributes, I mean, this is in front of a park and a surf club and a bowling club, and they're not going anywhere, and then you have the beach. So some of the just sort of micro things that we look at. This is something that people are looking for, high quality townhomes in that sort of, we like to say, 3 to 13 kilometre circle of major CBDs, that call it the inner middle ring. High quality, low maintenance, some security, some space. Otherwise larger apartments, so 3 bedrooms or 3 bedrooms plus an NPR, or 2 bedrooms plus an NPR, which is a multi-purpose room, which gained a lot of traction obviously during and after the pandemic, where people are working from home some days. There's that theme of people looking for more amenities, security, proximity to entertainment, healthcare, schooling, etc. I mean, these are the things that people look for, and it's understandable, because if you're someone trying to rent something, then again, these people are trying to get those same attributes as people are trying to buy something to live in. And it's just ongoing. So they're the sort of things that are not, you can't just say, we'll go and build another 10 or 100 or 1,000 of these, because you can't. So then the other thing you look at, obviously, because you want to be tax efficient, and you want to try and buy something, if it's an investment, in the most efficient manner. In most cycles, and this is for Australian tax residents, this is sort of what it looked like when you're buying an investment property. Who's paying for that? The tenant, 70 odd, tax ATO 20 odd, and you about 6. Now this has changed a lot over the last 12 months, as you've seen this big run up in interest rates, and it changed a great deal in the prior couple of years when you saw the massive change on the downside to interest rates. So if you look at this, this is for a non-tax resident, that's going to cost, buying this property is going to cost about $280 a week in your cash flow. And if you look at that same situation, if you were an Australian tax resident, it's actually not going to cost you anything. In fact, you're cash flow positive by $60 on an after-tax basis for someone who's paying the highest tax rate. So look, interesting scenario, and I'll come back to this because someone asked a question about this, so I'll cover that off at the end. But, pardon me, generally speaking, again over the long term, we've found that for Australian tax residents, it generally costs about between $150 and $250 a week for them to purchase an investment property and keep that for the long term. The last 5 to 6 years have obviously been different to that because you've had rates go down to nearly zero. So we've had very cheap borrowing rates, and that's had a massive impact on bringing that cost down to being a negative cost, whether you're an Australian tax resident or not. What's happening now is, I suppose, that you're getting these increases in rental incomes, which are offsetting some of the increases in interest rate repayments. So you're going to find a situation where if you're an Australian tax resident, it's probably still going to remain, I think, cash flow neutral over the next year or so. And if you're a non-tax resident, there's going to be a cash flow component cost to you for that time until you get either rates moving down or rental income increasing further. And I think we're going to see rates coming down as most of the banks are predicting. So over 10 years, and I think that's a good way to look at it, is how much do you spend? It's about 90% from the tenant, 10% from you. But this is where I've come back to a question. Who's one of our viewers who's an Australian expat, and he's saying, well, what happens to this money that we're losing? Well, actually you're not losing money, it's costing you money to buy an asset, but I'll come back to what happens with that. And this is just something to sort of, sum things up on, because real estate is a long-term investment, so it's not easily divisible. You can't just go and sell a bedroom. There are higher costs involved in buying and selling. There are, generally speaking, over the long term, higher nominal capital gains involved, so you've got to look at a tax position on that, look at your tax residency when you are looking to sell that asset, if you do have to. But if it's a matter of choice, and these are again the statistics that we look at, the highest level of sales, generally speaking, are in years 4 to 8. So 4 to 8 years after someone's bought something, that's the highest nominal sales volume time, as you can see. Yet, as I say to people, if you put in the effort up front, or get someone to do the research and help you, you don't have to do a lot. You just keep that asset, because as we can see here, over the long term, the highest nominal returns are in years 20 to 30. And you don't have to do anything. And you don't have to do a lot of tax planning because there's no disposal of an asset, so there's no potential tax to pay. So it's really about that. And unless you have a need for the capital or a far better way of deploying it, you would tend to potentially not have a transaction take place. And quite often it's more difficult to do nothing than it is to do something. A lot of our clients in finance will appreciate that, especially people who trade financial instruments. It's very hard sometimes to do nothing, but it can certainly end up giving you by far and away the best outcome over the long term. So just tying it all together, we've been doing this, as I say, for well over 3 decades. We, through our lending business, can assist clients, both Australian domestic clients who are not medicos or lawyers, with an 85% loan to value ratio without having to pay mortgage insurance to the banks, And we can also do that for Australian expat clients who are earning foreign income, giving them that same benefit if they're a client of ours. We help people look at their own situation and, if possible, help them not pay any tax in Australia on a legal basis. We've helped many clients over the years, and we do have exclusive access to some pretty high quality assets, although, as I might mention, currently that pipeline remains pretty challenged due to the interest rate environment and just the just the demand situation from buyers from local sources or anywhere around the world. What to do next? Well, if you like what you're listening to, then also subscribe to our YouTube channel and click like, because we do a weekly Q&A session there and cover topics that people send us questions in about. If you want us to assist you further, then please just don't hesitate to email us or reach out, and we can look to seeing how we can best assist you in your own personal situation. And if you don't mind, we'll send you a feedback form if you complete that, because it's always good for us to get some feedback in relation to future content or what might be best for you in terms of timing, etc., to listen to future reviews. So let's just have a quick look now at some of the questions we've got here. And there's one. Warwick, are you on the line? Because you sent a question in, and I had a question for you actually on that. Angela, hi, how are you?
Good, thank you. Yeah, good, thanks, Doc. How are you?
Yeah, really, really well, thanks. Yeah.
Good.
Been for your morning surf, have you?
Yes, I have, yeah, it's lovely, thank you. It was in the rain actually, it's raining, but it was still 20 degrees. But...
Still good anyway.
Yeah, it's great. Yeah, so here's my wet hair, sorry.
Oh, wow. Oh, gosh. Many happy returns for the day. Look, I'll wait for Warwick to come online, because he had a question there, and I just need to clarify that a little bit. But we have another question from Jacqueline, and she said, can I use a fully owned property in Sydney as security, and then I'm going to sell that in 2 years' time because of CGT? What are some other options? Well, like a lot of questions, it helps if you get a bit more context around that, because the answer to that question would be yes, you can use your fully owned property in Sydney as security. But if you're looking to get a loan, then sometimes people leave out important factors. For example, are they a non-resident, and are they self-employed? Like, have they got their own business, which may make that a lot more difficult? Or are they utilising the equity in that for perhaps a business purpose, and is that going to impact their personal situation? So quite often, and in this instance as well, you need to look at different parts of that equation to see how that's going to fit in with obviously what the goal is, because the goal is not just to use the property as security, it's to then obtain funds from somewhere for a particular reason, and we've got to see if we can make that work. Here's another question. Deflation, could it happen? Sure. Yes, it can happen. I mean, you look at, say, somewhere like Japan had deflation going on for a very long time, and what would that look like for the Australian property market? Well, in deflationary environments, most asset classes and most asset prices will decline in value. So now you've got to look at the realism of this. Certainly at the moment, deflation is not one of the issues on anyone's radar in Australia, or certainly in most developed economies. In fact, it's the opposite. It's trying to curtail inflation. So, central banks raising their official cash rates to do so, to try and stymie demand in the economy, can sometimes be, as history tells us, counterproductive, because in many senses it can also fuel inflation. So deflation, whilst yes, it's a possibility, it's well below certainly my base case. It's something that's a potential outcome. So how that looks for the Australian property market, well, you know, I may never know, is the reality of that, because if I look at the macro drivers behind the need for that asset, none of them really would point to a deflationary situation developing in the medium to even longer term. We have such strong net overseas migration, we have strong population growth, we have limited supply. Even though the Albanese government has said, you know, we're going to build 240,000 homes a year for the next 5 years to help address this, I think that's a bit of a pipe dream at this point in time. The most we've ever produced is sort of, you know, 200,000. I think we'll, you know, over the next 5 years we're going to build new homes. It'll be less than 200,000 a year. So I don't think that's going to be the panacea that it's supposed to be. Politically, it may sound, you know, correct, but I don't think that's going to happen. So we're going to see an ongoing lack of supply, and certainly in areas where a lot of people want to live. So that's the other major factor, and that's why I say research is so important. Try and buy in areas where people actually, you know, will continue to want to live, and that's really important. So I don't see that as being an outcome. What is the mortgage funding availability for Australians in Singapore at present? I know that there's been a tightening, but how severe has it been with higher rates? Well, that's a really good question. And yes, clearly there has been a tightening, but it's certainly not targeted at any particular group. So whether you're in Singapore, Sydney, Hong Kong, or New York, the tightening's pretty much the same. I guess what it refers to is bank serviceability levels. So yes, we've seen a massive impact to people's serviceability. So where the bank says, you know, here's your income, here are your expenses, and this is what we believe we can lend you on a responsible basis. Currently, if anything, I suppose if you're living in Singapore, or the US for that matter, or Hong Kong, something that's pegged to the US dollar, you've had a bit of a tailwind, because the Australian dollar over the last over 12 months has really taken a hit against that currency, or those currencies, and so your serviceability would be probably 10% better than if you're living in Sydney. Warwick, thanks for joining us. I looked at your question there.
Good morning, Andrew. Thank you.
Yeah, so maybe if you can just expand on that a little bit as to...
So what, do you want to read it out for everyone, and then I'll add to it then?
So, is this the one about the security?
Using a property in Australia already?
Yeah, so you said, can I use a property in Sydney, I believe, as security?
Yes.
Yeah.
We're looking to try and buy down around Geelong. Just obviously trying to see if we can use that asset as leverage until we get back on shore to then offload that asset due to capital gains.
Whereabouts are you now?
We're in Hong Kong.
Yeah. So look, the answer is yes, you can. There's no issue with that. And I've just covered this before you came online there. It's more around, you know, again, your borrowing capacity. So looking at your income and expenses in Hong Kong, and as long as all that stacks up for the amount of money that you want to borrow, yeah, there's no difficulty unless there's something, you know, uniquely rare about the property that you have in Sydney, but I'm sure there isn't. Yeah, you could use that as security and go and buy something in Melbourne or in Victoria.
Yeah, all right, okay, thank you.
And you know, as I said earlier, I mean, we can provide you with, generally speaking, an 85% LTV loan to LVR based loan on without paying mortgage insurance to do that.
Okay, all right. Good, we'll have to follow up.
Yeah, follow it up. Just let us know. We can easily book a time for that.
Okay,
yeah.
Great. All right, thank you.
So look, one last one there, and I'll come back to this. It's about the depreciation provisions in the Australian tax law. because I had a viewer say to me, well, look, you know, now that interest rates have gone up, you know, up until a few months ago, it wasn't costing me anything to make my mortgage repayments on these investment properties, but now it is. What's happening? What happens to that money that we're losing? So you know, you've got to look at things in two different lights. One is a cash flow situation, so you're having to contribute money on a monthly basis to maintain the debt portfolio against those assets. And I think, you know, a bit of complacency creeps in because it's quite normal. And certainly for most Australians, we know that over the decades, if you've gone and bought something for $1 million, that generally speaking, it may cost you something. So to live in a world where you think that's never going to cost you anything because interest rates were close to zero, that was really just a bit of a hiatus of really good fortune for people who were borrowers. But I guess the big benefit of this situation is that this cash flow depletion is actually not a total loss, because there is no sort of half-life on the tax credits that you build up. And if you're that's negative gearing. So if you're spending more money than you're earning on investment producing asset, that shortfall you can then save up over time, and you can utilise that. So if you then repatriate to Australia and you've got a job, so you've got personal exertion income, you can use those losses you've accumulated against that, or if you sell something and make a capital gain. So it's actually, and you know, this person will say, oh, okay, I just thought I lost that money. Well, you know, it's like a bit of a forced saving situation, I suppose, but certainly we're one of the few tax jurisdictions around the world that have that ability, and it's quite a good one. Anyone else have any questions? Well, I'll bid everyone a good morning or good afternoon or evening, depending on where they are. Wish you all the very best for the end of the year, and hopefully be able to give you some good insights into what's happening in 2024. So the feedback form's out there. If you'd be kind enough to complete that for us, we appreciate that, and see you soon. All the very best.